It is my honor to introduce you Tony Grant. He is the fellow of RICS, Royal Institute of Chartered Surveyors, since 2001, and he was born in London, UK. He has spent a lifetime in real estate profession. If I talk about his achievements, it will take us the whole night. He founded the Grant and Partners, that was the property advisors, appraisers, surveyors, and the estate agents in London. The firm initially specialized in industrial and warehouse agency, and later diversified into office property development and investment consultancy, as well as project management and property management. And later part of his career, he moved to New York to become president and CEO of London and Leeds, which with the direct responsibility for a 4.7 million square foot office development program in Boston, New York, Washington DC, and Miami, representing approximately 1.5 billion of investment. After that, he joined the board of Olives Property PLC as a chairman and joint chief executive. In 2003, he was elected the honorary world president of FIABCI, that is the International Real Estate Federation, and for Coastal Carolina University in 2016, the Grant Center for Real Estate and Economics at Coastal Carolina University was launched through a major gift through Tony and Carrie Grant, and he now lives in Murrells, Inlet, South Carolina. Tony, right now, let me share the presentation for you, and the floor is yours. Now you can take charge.
Thank you. And I think you need to go to the slide show.
Okay, slideshow, yeah.
That's good. Thank you. Well, thank you for that very kind introduction, Sourav, and it's a pleasure to be here. We prepared our presentation, Sourav and myself, quite independently, and I'm just hoping that my figures are not too out of whack with yours, but we shall see. I'm going to cover the trends as I see them in the whole world of real estate, using the same sectors that you've mentioned, look at what's happening with ownership and leasing, and then in accordance with the title you've given me, we're going to switch to a micro view of the various lease terms that are being negotiated between landlords and tenants in all sectors, and see what might happen to the various elements of lease negotiations later on, especially after the COVID period. So let me start by saying that the current period is totally and completely without precedent in my entire lifetime, which is getting on for something like 80 years. Nothing like this has ever happened anywhere. So we're in new territory, I think. And in 15 months, as Dr. Batabial mentioned, we've gone from a remarkably strong economy into a global economic depression, accompanied by a curtailment of basic freedoms of movement and assembly, and a near shutdown of big parts of the transportation and hospitality sectors. Then there was a reversal and a dramatic recovery, with record low interest rates, a record high national deficit, and a record high stock market. And most recently, some financial journalists have been reporting on the economy roaring back into life, and in a way it's quite breathtaking. But I find it quite difficult to work out which of the changes in supply-demand patterns in real estate are here for the longer term. So I'm going to talk briefly about trends in three of the main sectors that Dr. Batabial mentioned previously. That is offices, retail shopping, and industrial, which includes warehousing and distribution. So can we turn to the next slide, please? Well, there's offices, city centre on the left, typical suburban on the right. And next slide, please. Right. We're all aware, of course, of the work-at-home response to COVID, but a parallel movement seems to be work near home. And the appeal of the suburbs seems to have suddenly re-emerged, and demand patterns are shifting substantially in favour of out-of-town offices. However, the entire sector, including suburban offices, suffered a downturn with a national vacancy rate in the order of 15 to 16%. And that is a very high vacancy rate, particularly for offices. Net absorption was negative in all top 10 office markets during the last quarter of 2020, with vacancy rates continuing to rise and rents actually falling in some locations, as we saw earlier. As the technology of remote working and virtual meetings continues to progress in leaps and bounds, the question is constantly being asked whether in future headquarters and regional offices will be primarily an occasional meeting place for staff, their clients, and their customers, with regular motivational and corporate culture sessions, but no longer perhaps a traditional workplace. Can you go to the next slide, please? Well, let's spend a moment on other possible trends in offices. The focus in all parts of society on environmental issues is becoming a major factor in the office market. There's a growing demand for healthy buildings, and we can expect leases to contain more language about the apportionment of responsibility for addressing health risks. A widespread social conscience is becoming aware that the built environment accounts for something like 36% of global energy consumption and 40% of CO2 emissions. So we can expect a growing demand for buildings to be green in style, specification, and operation. Tenants of multi-lease properties will look for more commitment from landlords with regard to healthy conditions, including quality of air and the use of safe material in building finishes and building systems. This was already happening pre-COVID, but it's likely to accelerate quite fast in the post-COVID office markets. In addition to a demand for green, healthy workspace, we're seeing a trend towards the provision of more services and amenities for staff in office buildings. And in that respect, offices are becoming more like shopping centres. More and more landlords will need to deliver a positive workspace experience through existing architecture, artwork, mini shops, fitness centres, coffee shops, and other catering and the like. In some cases, these facilities may well have to be subsidised by landlords in order to keep their buildings occupied, especially in the immediate post-COVID period. Can we go to the next slide, please? Now we come to the retail shopping centre, and I have to say that our third speaker today, Mr. Rox Pollard of Colliers International, is a leading authority on retail shopping. I'm much more of a generalist, so I'm going to choose my words particularly carefully and hope that he agrees with at least some of my comments. Mr. Pollard has told us on more than one occasion at CCU's Growth Summits that what is called bricks and mortar retail will remain an important real estate sector, and that theories of it being largely replaced by online shopping are simply misguided. Next slide, please. Oh, in fact, I need the slide after, because we stayed on this one. So if we could skip to the next one, and yes, that's the one. I think, sorry, no, we need to go back one. That's it. I was going to say that there can be little doubt that retail property has been seriously affected by the pandemic. We know that. According to market reports, in 2020, approximately 15,900 retail stores closed in the USA, and in 2021, that number is expected to be higher. Recent estimates suggest that there was a 34.5% decrease in overall shopping volume from May 2019 to October 2020. Restaurants, as Dr. Batobial mentioned, are one of the worst hit subsectors. Revenue is down by at least 20% as compared with March 2020. 110,000 restaurants and drinking establishments are said to have closed either permanently or certainly in the long term due to COVID. So in those circumstances, and not surprisingly, there are extensive negotiations and renegotiations between landlords and tenants, as well as owners and their financing source, their bankers, for the restructuring of leases and loans in the interest of survival. Next slide, please. Tenants need lower rents to cover costs, let alone make a profit. Landlords require occupied shops and longer lease commitments in order to retain bank support. So the result is often a partnership approach. New or enhanced arrangements may well include the 4 items that you'll see on screen. First, exclusivity inducements, which restrict or exclude entirely new occupiers who would then be competing with existing tenants' trade. Second, a low base plus a percentage rent instead of a fixed high rent regardless of the tenant's sales. You probably all know that percentage rent is a percentage of tenant sales. A reduction in rent if the percentage of shops open and trading in the shopping centre falls below a preset, predetermined and agreed level. And then the fourth item is provision or financing by landlords of capital improvements like drive-through lanes or curbside pickup areas in order to enhance trade. Next slide. Thank you. On the banking side, the retail and hospitality sectors are considered to be distressed in some areas with a 10% delinquency rate on loans, that is bank loans to owners. Lending to retail property owners is reported to be at 75 to 80% of pre-COVID levels, based on a new ratio of 60 to 70% loan to value. But it's worth bearing in mind that the value, the capital value itself on which the loan ratio is calculated, may well have been reduced over the last year or two. Lenders, of course, want to see occupied units with tenants who are covering their costs and committed to reasonably long leases. Interest rates at the moment are low, so deals are being done whereby landlords' borrowing costs are reduced, enabling them to lower rents and improve facilities in return for reasonable and sometimes longer periods of commitment. Even if interest rates rise as a result of inflationary pressures, which I believe is quite possible during the next several years, this trend is likely to continue. Slide, please. Finally, we come to the industrial warehouse distribution sector. And if we could go to the next slide, please. Right. From an investment standpoint, COVID-19 has resulted in this sector finally coming of age. It took an awful long time. During the second half of the 20th century, it was the poor relation of commercial investment real estate. Cap rates were at around 10%, during that period, as compared with prime office and retail at 5 or 6%. Now, all three sectors are at around 5% prime. We are undoubtedly, as Dr. Batterbiel mentioned, in a strong industrial warehouse market. At the end of last year, vacancy levels were as low as 4.6%, and a record-setting 104 million square feet were absorbed in the fourth quarter alone. That's tremendous absorption. Next slide, please. The growth in e-commerce is, of course, a major factor in increased demand and values. Reports indicate that in 2020, e-commerce at $861 billion was more than 21% of all retail sales. It's expected to reach 1.5 trillion by 2025. And of course, it's fair to say that you can't work at home if you're storing and distributing or manufacturing products. So, full-scale occupation, particularly of warehouse and distribution units, is expected for the foreseeable future. But, and this is a big but, as usually happens, strong demand is beginning to lead to overbuilding in some areas. The dynamics of negotiation are just beginning to swing towards the tenant's advantage. So, we should regard conditions in the industrial warehouse sector as being varied and variable depending on location. Next slide, please. That takes us to the point where hopefully we've looked at some key trends about leases, and we now take a micro look at some of the terms of leases that landlords and tenants may be negotiating post-COVID. So first we come to the identity of the tenant. And tenants generally tend and seek to limit their liability. And of course, that is the purpose of limited liability companies. They may well put forward as prospective occupiers a corporation, even a new corporation, with a low asset base and very modest profitability. The landlord naturally asks for the strongest entity or a substantial guarantor or a rental deposit. Now, this is extremely important, and in the post-COVID world, with its initial low interest environment, the bankability of the property, the terms offered by lenders and capital values will, I believe, be substantially influenced, more than usual, by the strength of tenants. So, we can expect landlords to give rental and other concessions in return for top quality guarantees of the lease terms. Next section of the lease I want to look at is use of the property. And in normal times, the tenant wants the lease to permit the widest use. The landlord prefers narrow use restrictions tied to a tenant's business. This gives greater control, especially with regard to subletting and assignment. Post-COVID, the traditional language about permitted use may be replaced or supplemented by more stringent requirements on building use and also the use for healthy, environmentally friendly occupation. This would prohibit the creation of noise, dust, fumes, vibration, and other nuisances, especially obviously in the industrial sector. In addition, no outdoor storage would be permitted unless attractively screened. Next slide, please. Next section of a lease might be options to renew. And the tenants naturally prefer a short initial term with several options to renew. Typical might be a 3-year lease with 2 or 3 3-year options. Now, this gives the tenant long-term control of the property without any commitment to justify it, any long-term commitment, that is. Landlords, needless to say, seek the exact opposite. And post-COVID conditions may result in longer initial leases rather than renewal options in return for lower rents, contributions to fit-out costs, free rent periods, and other inducements. That way, the longer leases, which are welcomed by banks, will promise a more secure cash flow during the loan period. They can also result in lower cap rates, which of course mean higher capital value. Next item is rent adjustments, and typical adjustments in recent years has been 2% or 3% fixed increases per year. But in the longer term, currently, more rapid inflation is expected by quite a number of financial experts and commentators. As and when markets strengthen, higher increases and even CPI adjustments to the cost price index, that is the cost of living, are possible. And that aspect is worth tracking very carefully if you're involved in the development and investment sector. Next slide, please. Now we come to payment of rent, and in post-COVID conditions, I think banks are likely to be less tolerant of late payments on the part of their borrowers. Not that they're massively tolerant now, but I think they might be even stricter. And this in turn could transform landlords' policies and lease terms on delinquencies. We could see bigger penalties for late payments going as high as 5 or 10% per month, plus administrative costs, plus legal expenses. But those charges may be affected in some states by usury laws, which may regard those penalties as unreasonable or excessive interest rates, which then would lead to a curtailment of penalties for delinquent payments. More and more leases may well require that tenants set up electronic bank transfers for automatic payment of rent on the first of every month, with a severe penalty if the transfers are cancelled or if they fail. Next slide, please. Now we come to reimbursement of landlords' expenses, and this covers insurance premiums, real estate taxes, and other local charges like stormwater drainage and waste disposal. The requirements may become more extensive post-COVID. Payments are likely to be required immediately upon invoicing by the landlord, and this can mean, in some cases, that the landlord will actually receive the tenant's reimbursement before he has to make payment to the outside source. And again, cash flow post-COVID will have an even higher priority than previously. Insurance, I would add, is a substantial cost, and it may be in the landlord's interest to use the tenant's own insurance sources to avoid conflict and delay. It's a practical approach. It's not usually found in the lease, but I found over a number of years that if the landlord uses the tenant's insurance broker, the tenant can be more assured that the premium charged is fair and reasonable, and we will then reimburse very quickly. We come to services and amenities next, and I anticipate that when the pandemic is over, there will still be a need, especially in multi-leased properties, to provide amenities that attract tenants, their staff, and their customers. Whether the cost of those amenities is recoverable by service charges will naturally depend on the strength of demand and corresponding rent levels. I think it's likely that triple net leasing, where the tenant pays for absolutely everything directly or through service charges, will continue to grow and will enhance capital value as well as net operating income. So that's a positive factor from long-term and institutional investors' viewpoint. Next slide, please. Maintenance and repairs. And generally, the landlord is responsible for structure, including roofs, replacement of HVAC systems, and wear and tear. But the trend post-COVID may well move towards the European concept of FRI leases. FRI stands for full repairing and insuring. And in many countries, including the UK, or perhaps especially the UK where it all started, the tenant is responsible for absolutely everything, including when the lease comes to an end and the tenant leaves the building. The building has to be handed back in absolutely first-class condition, not allowing for wear and tear. But of course, the rent tends to reflect that when the tenant negotiates those leases. In multi-lease properties, that arrangement can be achieved through service charges and may even include contributions to a reserve fund for long-term repairs and replacements. Alterations, charges, and additions. And here, my thought is that post-COVID, landlords may become stricter about allowing alterations which could be costly to reverse if the tenants fail. Therefore, more leases are likely to contain an absolute prohibition against changes without landlord's consent unless they are easily movable, like to mountable partition, or if a deposit is made to cover reinstatement, and that deposit has to be held by the landlord and supplied by the tenant. Next slide, please. We come to assignment and subletting. And here, I think stricter rules are likely to apply post-COVID. The landlords will be entitled to receive more financial and operational information regarding any proposed new lessee and have greater discretion on whether or not to accept them. With longer leases, and in order to give at least reasonable protection to the tenant, there will still be a proviso that consent for assignment or subletting will not be unreasonably withheld or delayed. After the assignment or subletting, rent will be paid directly by the new tenant to the landlord and not through the original tenants. However, the original tenants will still be jointly and severally liable for all the lease obligations of the assignee or subtenant. Next slide, please. And here I'm glad to say that we've come to the end of that long list of lease provisions. And this one deals with health, safety, environmental, and regulatory compliance. I'm afraid that's quite a mouthful. New federal, state, and local regulations about health, carbon emissions, working conditions, safety, and so on have already resulted from the pandemic, as well as recent major political changes. Landlords and their banks are likely to require tenants to meet the cost of complying with both existing and new laws, new codes, statutes, and ordinances arising out of their use and occupation of the premises. Tenants will be required to undertake not to allow any hazardous substances of any kind to be brought onto the premises, and they will be responsible for any fines or costs arising from contravention. Next slide, please, which is the final slide, and we have come to the end of this attempt to look at trends and the effects on lease negotiations. I want to end by stating the obvious once again, and that is lease negotiations always, but always reflect the economic strengths and weaknesses of landlords and tenants at the particular time and in the particular place. So there will be many exceptions to the trends I've endeavoured to identify. Nonetheless, we can anticipate that the main changes in the post-COVID leasing era will also be a reflection of the national and indeed global focus on the items that you see on screen. Public health, green buildings, renewable energy, employee and customer welfare, and new technology, which includes 5G communications, artificial intelligence, the arrival of drones, as well as electric and driverless vehicles. The need among banks and investing institutions for security of income, sometimes at the expense of higher initial returns. And then finally, and naturally, levels of inflation and interest rates, which we should all be watching very, very carefully indeed. That's the big factor. So thanks very much for listening, and I look forward to our discussion later on in the session. Thank you.
Thank you, Mr. Grant, for the wonderful presentation about the lease negotiations. Now we will move to our next presentation.